Hello, hello, hello. Yes, this is Atilla Yesilada. Yes, you are at Real Turkey channel. Today I'm cooperating with the premier economics YouTube channel in Turkey, Mesele Economy, to prove to you that I really exist and I'm not a prisoner in a dingy room in the roof. And we do have actually a nice studio. We're going to talk about the Turkish economy, which I neglected for a while. And the title of this video is Too Fast for Comfort. What do I mean? Well, Turkey has these chronic problems. One of them is inflation. Currently, inflation is 62%. CPI expected to rise to 70 at the turn of the year. Current account deficits, that is external deficit, roughly 4.5% of GDP. Not huge by some standards, but if you don't have any foreign financial flows coming in, financing it becomes a problem in a country where everybody wants to hold dollars and nobody TL. And finally, budget deficits. Now, I'm not going to talk about budget deficits, for which I'm going to shoot a separate video, but to bring down inflation and current account deficits, one needs to cool down domestic demand. Because lower demand, lower imports. Lower demand means companies don't have the flexibility or the luxury to increase their prices. And in fact, that's what the latest inflation report written by Central Bank of Turkey stated. It stated that inflation has many causes. After the Turkish elections, the exchange rate shock, that's the higher rate of depreciation of the currency, plus the huge tax package, about which I shot a video, you can see it below, have increased cost push inflation. But right now, these have all been reflected to final prices. We have to deal with inflationary expectations and domestic demand growth, which is too fast for comfort. Inflationary expectations, if you follow Fed or European Central Bank, are difficult to deal with. You need to have credibility. That is, as a central bank, when you say, I am not going to loosen monetary policy until inflation expectations converge to 2%, there is no way you anchor them. So let's skip that and talk about domestic demand. Is domestic demand slowing down? Can it slow down? And can Turkey escape the winter period without a currency shock, that's a currency crisis, or a massive blow up at the inflation front? Turkish economy is slowing down, to summarize the content of this video, but it's not sufficient. It needs to slow down much faster. Put it this way, my sense of the GDP growth rate is 4%, slightly higher than Turkey's optimal growth rate, which by itself is inflationary and also boosts external deficits. Turkey needs to slow down to a pace of 2%. And we don't see that in the recent data. The latest data from which we can discern where the economy is heading is October foreign trade data. Now, foreign trade, obviously, if you have a strong domestic demand, foreign trade deficits expand because you simply import more, and some of the exports are diverted to the domestic market. Of course, trade deficits can be caused by gold, which is Turkey's case, as well as energy imports, about which you have no control, because even to shoot this video, I'm consuming energy. So to understand how domestic demand is faring, we look at a sub-index called non-energy, non-gold, or core trade deficit. Now, after declining in September, that began to increase in October, which is not good news. We also look at credit data, which is also up to date. It shows credit demand or credit volume declining in seasonally adjusted terms, which is good in the sense that it may lead to a lowering of the domestic demand. But since 2017 or so, the total loan to GDP ratio declined by 20 percentage points, from 70% of GDP to 50% of GDP. And if the Turkstat data is to be believed, it had no impact on growth. So going into the winter, there is really no hope. As things stand, that domestic demand would have a depressing effect on inflation and certainly not on current account deficits. Could things change? They could change in a positive direction, but they could also change in a negative direction. Let's start with the negatives. Obviously, we have two wars, one to our south in the Middle East, one to our north, Ukraine and Russia. If for some unforeseen development, these wars lead to another rampage in energy prices, then, Turkish economy would be devastated. I mean, some experts say that in the worst case scenarios concerning the Middle East war, Brent oil prices could range anywhere from $124 to $175. That would almost double Turkish current account deficits and add 10-15 percentage points to inflation. The second problem is more domestic and internally driven. Since we're a very high inflation country, statutory minimum wage, civil servants' wages and salaries, and pensions are adjusted for cost of living. Now, there are two ways to do that. A, you can compensate all the participants for accumulated inflation. Two, in particular, if you want to anchor inflation expectations, you can compensate them for the projected inflation. Now, Mr. Mehmet Şimşek, Turkey's economy czar, is urging Mr. Erdogan, our president, to do the latter, that is to compensate people for projected inflation increase. That would be 36% according to central bank research. Accumulated inflation, we're talking about, not 65%, but something like 50% because people received pay hikes in the first half of 2023. There is a huge difference in terms of, the actual money you put into people's pockets, which they go out and spend, which boosts both imports and inflation. And in terms of the psychology, if you can convince all the agents in the economy that no matter what the hardship, no matter what the political pressure, you are not going to raise their incomes above and beyond what you expect inflation to converge to, obviously everybody is going to reduce their income or price or wage expectations. I don't know. So far, Mr. Erdogan surprised me every day, for good or bad, after the elections. I hope that he listens to Mr. Mehmet Şimşek. Otherwise, central bank expects Turkish inflation to peak at 72% in the first half of 2023. When you increase wages and salaries too much, that could be delayed to the second half of 2024. But there are also positive developments. The first positive development is that TL savings rates are increasing much faster than the policy rate. And at some point, this has three impacts on the economy. First, obviously, people want to put their savings into Turkish lira deposits, which look relatively more lucrative compared to hard currency deposits. Two, they may increase their propensity to save. That means instead of spending their money simply because it yields no return, they might want to put it in the bank for rainy days. Three, when deposit rates rise, so do the loan rates, and higher loan rates, as is the case everywhere in the world, depress the credit demand, in particular consumer credit demand. You don't want corporate credit demand to decrease because that's usually related to production and exports, which you want to maintain. You want to reduce demand. If you could reduce demand for mortgages, cars, or anything you buy on installment and consumer loans, obviously that will have a significant effect on inflation. And I think we're going to get there. I expect the central bank to raise interest rates by another 500 basis points to 40% per annum, which is still negative, but they can use what we call macroprudential measures to increase the gap between the central bank policy rate and the deposit rate. Currently, that's 10%. So if the policy rate goes up to 40%, the simple annualized gross TL deposit rate would be 50%, which is much less negative. But if through these macroprudential measures, if you can increase that gap to say 15 percentage points, which is I think what they are going to do, then you have a valid case for all the positive effects of these deposit rates to be reflected to the economy. And of course, there's always the possibility that, at some point, people simply run out of money because of high inflation. This is what happened in the United States and in Europe. This is why only 14% of Americans think Biden is doing a good job on the economy, simply because they spent when inflation was high, and now there's really nothing left to spend. This could be the case. I am really not very optimistic, but that's one thing that I can definitely say. If you look at my past, I have predicted a currency crisis or balance of payments crisis in Turkey for the last 5 years. This time I'm not doing that. I think we are going to have a relatively low rate of depreciation, and the current account deficits will be manageable, but inflation is going to remain a huge problem. Can we ever solve that problem? Wait for March 2024 local elections, about which I will shoot another video to tell you who wins what and what happens to Mehmet Şimşek and his plans to tame Turkish inflation in local election scenarios. I want to thank my content collaborators, Mesele Economy, one more time, and John there, the one who is behind the camera, for allowing me to shoot this great video in a professional setting. And I want to thank all of you for your comments and for watching this video.